back. This is David Reyes, AM 760 KFMB, and I'm very happy to have a guest with me, Christina Hess. Christina, how are you?
I'm doing fantastic. Thank you, David.
You're welcome. Christina is become a very, very close friend of mine. I adore her. But you're not here to have me say that about you, Christina.
But I appreciate it nonetheless.
Yes, it's true. But she is an excellent estate plan attorney, and we're gonna have the great opportunity to have her talk about some asset protection, and some ways to save a lot of taxes on your IRA. So really listen up today for this segment. And if you've listened to me for long enough, you know I'm a very conservative person with my clients' assets. And, you know, the old Warren Buffett statement that he uses about money is his first rule of thumb: don't lose money. Rule number 2, don't forget rule number 1. And I apply that to taxes as well, because if you overpay in taxes, that's just like losing money. That's the way I look at it. Yeah. That's like nails on the chalkboard for me. So I do everything possible to help my clients reduce their taxes, both on an income tax basis and an estate tax basis. And today, Christine is going to help share with you a strategy that is probably the most bang for your buck in talking about how are you going to protect the estate for yourself and your children and mitigate the taxes significantly. We're talking dramatically, like cut in half. So, Christina, tell me, you know, what do most people do, you know, when they have a trust and we're talking about IRAs today. What is your experience when you see clients that have large IRAs and they pass and they go to the kids? What is the typical scenario?
Well, a typical scenario is, so once the parents are gone, they'll often nominate their adult children as the beneficiaries. Yeah. So, you know, once they pass, the IRA becomes an inherited IRA. And there's some problems with that. So let's say John Sr. passes, his wife is gone. He leaves his $1 million IRA to his son, John Jr. So then John Jr. gets the inherited IRA in his name. Now, if he decides to take a distribution right away, let's say he liquidates it, he's immediately going to be hit with income tax. Ordinary income tax.
And how much can that be?
Well, if it's a $1 million IRA, right, and he takes a large let's say he cashes it out. He doesn't get any advice. He doesn't talk to you. Yeah. He's certainly not a client of yours. Yeah. He doesn't get any advice, and he just goes, oh, look at this. I'm going to go buy a house on the beach. And he cashes it out. This is ordinary income for him. Ordinary income, so he's immediately going to be in the highest tax bracket.
So it could be in the high 40s, 50% tax bracket. With state, federal, Obama surtax,
right,
you could be up in that level, 50%.
Yeah, so at least 43.
Yeah, his million becomes $500,000. Let's just use round numbers, correct?
Sure.
So, and quite honestly, Christine, I see this all the time, is that normally, you know, that's just the way it's distributed. Because when you inherit an IRA, and correct me if I'm wrong, if you don't do any other plan at all, you pay tax regardless if you take a distribution. It's passed to you as $1 million as taxed because it's now taxable. Is that an accurate statement?
Well, yes and no. So if John Jr. takes the distribution, like if he cashes it out, then that's an absolutely true statement. That would become ordinary income for him. But let's say he takes out a required minimum distribution based on his life expectancy the first year. So that would be ordinary income.
But doesn't it have to be set up that way, though, to do that?
Well, he has to make that election within the first year after the death of his father.
And that's what I'm saying. It still has to be planning. Somebody has to help him to do that.
Yeah. But even if he does that in year one, so he's not going to lose half of it to the IRS in year one. He'll just have whatever his distribution was. Let's say in year 2, he decides to take out more than the required minimum distribution. Suddenly his stretch, as we call it, which is what, you know, when you take out the required distribution each year, his stretch is now blown. So
what does that mean? Because a lot of people don't know what a stretch is. So what is a stretch, and what do you mean by it's blown? So that's a lot of people don't know, because I teach this stuff and they don't know what a stretch is. So what is a stretch IRA?
Well,
what's the benefit of it?
Yeah. So when someone dies and it becomes an inherited IRA, the beneficiary has an option. They can either take it, if they take it all out in one lump sum, it's gone, it's done. The taxes are payable within 9 months immediately. they can stretch it over their life expectancy. So if you have $1 million and John Jr. inherits this IRA based on an actuarial table of his life expectancy, they're going to say how much he has to take out each year. So if he's 40 and he has a life expectancy of 80, then it's going to be a smaller amount that he has to take out each year.
So if he doesn't stretch the IRA out and he takes the money in a lump sum, that's what she means by blowing the stretch. So then all that money becomes taxable, correct?
Correct.
Yeah. So now you have this $1 million again that he inherited, and the will of the family was to have him get the $1 million. Now it's $500,000.
Right.
Right. So then what can happen? So now it's $500,000, lost half the money already. So what could happen after that you've seen?
Well, that's a great question. I just want to clarify. Once you blow the stretch and once you take out more than the required minimum distribution, you have 5 years to take it all out. Yeah. So he could still mitigate the tax over 5 years, but you're talking $1 million. That's hundreds of thousands of dollars in taxes.
That's right.
This is a huge estate disappearing that's going to the IRS.
Exactly.
So back to your question, what could happen after that? Well, let's say that he hasn't yet bought his beach house because now he's only got $500,000 after the IRS took their chunk. And then his wife decides to file for divorce. So then she's going to claim half. So he could potentially lose because he's now commingled it. He took what was an inherited asset, which could be, if with good planning, could be protected from divorce. And it's now in the community property pot. So she's going to claim half of it. So that's something that could happen. It could be lost in divorce.
So now you're talking about $1 million goes to $500,000 goes to $250,000.
Right.
Right.
Yep.
So we're going to get into some solutions, but first I want to make sure you can reach out to Christina or myself. And it's again Christina Hess, estate plan attorney, friend of mine, great person. You'd love to meet with her regarding this IRA planning we're going to be talking about here. You can reach her online at www.krhess.com. That's krhess.com. So let's get into, how do we fix this problem? Because there's other issues such as bankruptcy and all these things that can happen, but I think that's enough right now. If you have $1 million and now that turns into $500,000 because you do planning, and then you get divorced, and now that turns to $250,000 that the beneficiary received the son, and now you just gave $250,000 to your least favorite now, in-law, right? Or
Right.
So that's not fun. So what's the solution, Christina? What do we do to fix this problem and to preserve the estate?
Well, the good news is there is a solution.
Okay.
So the solution, and there's lots of different names for it, but essentially it's a trust for your retirement accounts.
Okay.
So I call them IRA legacy trusts because they're a
that.
great tool to create generational wealth, which is a fantastic legacy, right? But essentially it's a trust, and it can either be revocable or irrevocable, and it's a trust that so let's say you, David, or let's go back to John Sr. John Sr. would set up a trust, an IRA trust to be the beneficiary of his retirement accounts.
Okay.
So
does this have to be? Can you do this with your living trust, or does it have to be a separate trust?
It really needs to be a separate trust.
Okay.
In some situations you can use your living trust, but there's huge downsides of that.
So we need a separate trust.
You
just
really
do.
For
the sake of time for you, I want to, and I know that as well, but I want our listeners to know it is a separate trust that we have to create. So go ahead.
Yeah. So it's a separate trust, and then what happens is John Sr. doesn't lose any control. So he still has 100% control over his retirement during his lifetime. He can take out the required minimum distributions at 70 and a half, or, he can still do whatever he wants when he's alive. It's when he's no longer here, the trust then becomes he nominates the trust as the beneficiary. So then all of those retirement accounts, if he's got more than one, are all going to flow to the trust. Yes.
So let's do this, Christina. We're running up against a break here. So we're talking about ways to protect your IRA from taxation, litigation, and make sure you pass on the legacy that you intended to, instead of to the IRS or to an in-law that you now are of unloved from the grave here, so to speak, that we give the most amount of benefit to the family member that we care the most about. So if you'd like to reach out to me personally, David Reyes, you can reach me at 1-800-611-1967. That's 1-800-611-1967. or go to reyesplan.com, and I can introduce you personally to Christina or other questions you may have. So we're going to take a break. We're going to go in another segment with Christina because she's done such a great job, and I want to make sure that you get all these benefits and understand how this special trust works. This is David Reyes, AM 760, KFMB.